I've been getting asked a lot lately about the changes to the capital gains inclusion rate and how that's impacting retirement and plans for Canadians, seen as the rules come right around the corner as of June 25th. And to help understand those rules, let's start by breaking down the two-tiered system that it really is. If you are an individual, there's different treatment than if you have a corporation or a trust. Now, for individuals, capital gains in a year under $250,000 has no change whatsoever. So if you have a $10,000 capital gain, meaning you've sold something for $10,000 more than what it cost you to acquire, you're not going to notice any difference. It's still only half of that capital gain is included. So again, a $10,000 capital gain, $5,000 is included in your income and taxed based on your personal marginal tax rate. The only time there's a change is when you have capital gains in a calendar year that exceed $250,000, and it's only on the amounts that exceed $250,000 where the new inclusion rate applies. And what happens is that new inclusion rate is 2/3. So if you had a $300,000 capital gain, the first $250,000 has that 50% inclusion. That last $50,000 is now 2/3 being included in your income rather than only half. It's effectively a 33% tax increase on amounts greater than $250,000. So it's unlikely that most people are going to have big problems in an annual basis or on a normal basis if you are a salaried individual. But if you're a corporation, like if you have a corporation, you're self-employed and incorporated, and you've been investing in that corporation, whether real estate, stocks, bonds, mutual funds, whatever the case may be, and you have something that is appreciated, those capital gains are now being taxed with that higher inclusion rate starting at dollar number one. So a $10,000 capital gain for a corporation has 2/3 included. A $10,000 capital gain for an individual, only half, meaning it is less advantageous from a tax planning standpoint to have a capital gain incur inside your corporation. So what does this mean for planning? It means that if you are an incorporated individual who is planning for the long term and investing through your corporation, you might want to sit back and revisit your investment strategy because these new tax changes will have an impact on the amount of tax you pay each and every year, especially if you are buying and selling various investments and assets. For an individual, again, you're probably not going to encounter a lot of problems on an annual basis, but there are a few times in your life where you might exceed that $250,000 threshold. If you've had a cottage in the family, as an example, for a long period of time, that might have a sizable taxable gain, and you might find yourself paying at a higher tax bracket on part of the sale of that cottage. Or if you pass away and you've been holding a personal real estate portfolio, you have rental properties, or if you own small business shares and you pass away or you sell that small business, you will have some income potentially taxed at that higher inclusion rate. And so what it all means is that planning has just become even more important for timing of sale of assets, whether you are an individual or an incorporated person. Being very wise about your timing and your investment choices has never been more important. So if you are the kind of person who feels that this is going to impact you, now is the time to get ahead of your planning, speak to somebody who's a professional, and make sure you set yourself up and put your best foot forward for paying the least amount of tax possible. If you'd like more tips like these, you can find me on Facebook, on Instagram, or check out our website, www.cascadefinancialgroup.com.